There's a big debate over doing an S Corp or C Corp. I guess maybe some of the understanding that we know here is like one uses a Schedule C, one uses a Schedule E, where it seems like, and correct if we're wrong here, the Schedule C, which goes with the C Corp, allows us to be a little bit more liberal on some of the expenses, maybe use that Augusta rule, where the Schedule E is a little bit more audited traditionally. But maybe, yeah, take that and S Corp, C Corp. When do you use one or the other for people's
Mhm.
LLCs?
So in general, for real estate investment, an LLC is usually good enough. You usually don't want to be an S Corp if you're having passive activities, because I think there's a rule with S Corps where if you have more than like 25% of your revenue coming from passive, you don't qualify for an S Corp anymore. So in general, being an LLC for real estate investments itself is should be good enough.
I guess what point would you trigger doing a C Corp or S Corp?
I wouldn't recommend a C Corp in general. C Corp is mainly for if you're a startup, if you're looking for funding, things like that. Usually tech, it would be C Corps. But for if you're just like a self-management company, just managing your own rental properties, then an LLC should be fine.
I guess maybe I'm poking and prodding here a little bit. Then why do people on YouTube keep telling us why we should do a C Corp then?
For real estate industry business, but let's say it's an LLC that's generating an income. The time that you should convert into an S Corp is after all the tax strategies like revenue minus expenses, after all the tax strategies. If it still generates a net income, it's better to convert into an S Corporation to prevent self-employment taxes. Now, as to when is the time to convert from an LLC to C Corporation or S Corporation to a C Corporation, if your bracket is already at 37%, meaning like once you factored in the income of the S corporation or an LLC, combined it with your other W2 income, it if gives you 37% of federal taxation, then that's the time to convert into a C corporation because C corporations are fixed at 21% rate federal wise and 10% rate in the state wise or wherever state you are. So it keeps your taxes down. However, once you are under a C corporation, monitor it closely with your CPA because any withdrawals that you do out of the C corporation are considered dividends and it will be taxed at your ordinary rate. So that's usually how we advise our clients, especially if they have a business that suddenly went up or suddenly had a huge amount of income.
But to Fuchs' earlier point, if you're investing in real estate, you
Real
shouldn't be
estate.
paying a high taxes anyway.
Correct. Because
Yeah.
real estate normally they always generate losses because of depreciation, which is why it's better to stay under on it.
What if you have 1 year where you have a huge amount of depreciation recapture from one of the deals because it did really well? Maybe that year you would switch it to a CRS Corp, or I guess obviously
No,
talk on
still,
your.
because that one is classified as capital gains, and any recapture are capped at 25% taxes. They don't go up to your rate of 37%. So it's still beneficial, even if there's an exit in one of the deals or there's a sale of property.
We did a video on that
Mhm.
maybe about a year ago for people listening that went over this. You're washing your gains and it comes out, you got to pay taxes on it, but it's a lot lower rate. And we call this tax efficient. But if you want that video to go over that, let us know. I think it's at thewealthelevator.com/tax page there. But the last topic we wanted to at least touch upon was